This is starting section 20.1 about depreciation, and you'll see it says depreciation for financial accounting. Section 20.2 is a form of depreciation through the government, basically called makers. So I kind of combine these two together. I'll teach you each method and then we'll do more practice. All right. So this is just understanding the depreciation terminology. And we're going to round most answers to the nearest whole number amount. This is a common practice, when you're filling out taxes or doing anything to do with your taxes, that you just use whole numbers. So we're going to use whole numbers. It makes it nicer anyway because we have so much that we have to put in charts. Okay, so here's some information. The basis is the original cost of the asset, whatever it might be. It could be a car, a truck, it could be a copy, or just any kind of thing might be your asset. The useful life is the number of years the asset will be useful, and that's given in the question. It will tell you 4 years of useful life or 5 years of useful life. The salvage value is what the value of the asset will be at the end of its useful life. So after we've used it for 4 years, it has a worth of this, and that will also be given in the question. Here's more. The depreciable basis is the basis minus the salvage value. And that tells us the amount of the item that we're going to be able to depreciate. The annual depreciation is how much value that it loses each year. I'm sure many of you have heard of depreciation when it's related to cars. If you buy a new car and drive it off the lot, it just depreciated by several $1,000s on its worth. And so the depreciation is how much value it loses each year. And then the book value is what the asset's value will be at the end of each year. So you have the original book value and then you subtract the depreciation. So at the end of the first year, it's worth less than it was at the beginning. The end of the second year, then it loses more, and so on. These are 4 depreciation methods. The last one is the government one. And so we're going to talk about straight line depreciation, units of production, declining balance, and makers. We just call that makers for short. It stands for something that I'll show you later on in the lesson. So you're going to have to understand how to use each method as you work through a depreciation chart. So you may want to make yourself some note cards about how each of these work. Now there's some similarities in some of the things that we do, but you still have to understand each type. Okay, so for the straight line method, we divide it equally. So we split it into an amount per year that's going to be the same. Okay, we use our depreciable basis to do that. So we take it, say it has 4 years of useful life, then we're going to divide it by 4, and that will tell us how much to depreciate each year. Units of production, that we take the depreciable basis and we divide it by the amount of use. So the number of miles, the amount of copies, how many boxes will it make, that kind of thing. The declining balance uses the same percent of book value per year. So that means that we take the depreciable balance or the depreciable basis, and really we don't even have to take the depreciable basis on that one. We do have to know that for the salvage, how much the salvage value is, but we basically take the book value and we multiply it by a percent. And so we're given the percent and we figure out what percent to use each year. Okay, so we start with the straight line method, which is definitely the easiest method, the simplest method. And it assumes that your asset is going to lose an equal amount of value each year. And on several examples, we're going to be talking about a car for a salesperson to use. Okay. So your business buys a car for one of your salespeople for $16,000. you project that you can sell the car at the end of 4 years for $3,400. So by saying that, that's actually telling us something about the salvage value. So we're going to fill in each line here. 4 years is called the useful life. So that's how long we expect to be able to use this car, for instance. 16,000 is the book value. That's also called the basis. So in the terminology for depreciation, that's called the basis. The $3,400 is the salvage value, because at the end of the useful life, it will have a salvage value of $3,400. And then we take the $16,000, the original cost of the car, and subtract its salvage value, and that gives us $12,600. And we call this the depreciable basis. Oops, I left out my R. That's supposed to be a B. So the depreciable basis is that amount we get when we subtract. Okay, so this next example is about using the straight line method, and we already were given the numbers on the previous slide, so you can always look back to that. If you print out my notes, and you're going to have some of these side by side, the amount of the annual depreciation is going to be the depreciable basis divided by the useful life of 4 years. And so each year we're going to be able to depreciate $3,150. Okay, so all these charts are kind of set up in a similar way, and you can label in different ways. Like you could say, I did this when I was writing out some of the review questions. The annual depreciation amount, just the depreciation amount is fine, and so make it make sense to you if you're filling out the chart. The book value is $16,000, and then we're going to depreciate the same amount each year, so we simply write $3,150 on each year. This is how much we depreciate it as we work our way down the chart. And that's one of the reasons why it's the easiest. Now, to get the next value, this one, we're going to take the 16,000 and subtract 3,400. Or 3,400, no, we're going to subtract 3,150. And then that's going to give us the book value after it's depreciated for 1 year, and that would be $12,850. And then we do the same thing. So then we take the 12,850. I'm going to rewrite that. I had a kind of a weird gap there. The 12,850 and subtract 3,150. So the next year our car is worth $9,700. And then we subtract 3,150 from the 9,700 again. Right? We just keep subtracting 3,150. And then our car is worth $6,550. We subtract 3,150 again, and then our car is worth $3,400. And on our last line, our book value can never go below our salvage value. And it works out perfectly for the straight line method, which is nice. Okay, so that's straight line. That's the process. And now we're going to use the unit of productions method. Unit of production is one of those where we have to do quite a bit of work to fill out the chart compared to the straight line method. So we're just going to go through and fill in our blanks again. 16,000, remember, is called the basis. And I'm repeating this because you need to understand the terminology. That is very helpful as you work on these problems. 3,400 is our salvage value. right? That's what it's worth at the end of its useful life. When we subtract, we get $12,600, and this is called the depreciable basis. And then the 150,000 miles, in this case, that's going to be our total number of units, and we need to know that for this method. So that's called, we're just going to say that, the total number of units. Okay. Now hopefully I can work through this method before I have to stop the video, and that would be unfortunate if we have to stop it first. Okay, so to find the depreciation amount per mile, we take our depreciable basis and divide it by the number of units, in this case 150,000 miles, and that gives us this number 0.084, and that's how much we can deduct per mile. Oops. Okay, so we'll be deducting that amount per mile, and that just means we do some multiplication. So we start out with our book value of $16,000, and then we're going to use these numbers in our multiplication as we work our way down the chart. So 36,250, we're going to multiply that by the amount per mile, right? That's the number of miles for the first year. And this is how much we will depreciate, $3,045. So remember, we subtract that from $16,000 because the amount of our book value has lowered now to $12,955. And then we just keep going through our chart this way. So 32,600 for the second year. Multiply that by the amount per mile, which, you guys, that's about 8.4 cents per mile. And this is 2,738. And then we subtract, again, we subtract that from the 12,955 to get 10,217. Year 3 was 37,200 miles. Multiply that by our depreciation per mile, and that is 3,125. It's okay if we have a year that's higher than the previous year because we are simply using our number of miles to figure this. And then we subtract that from the 10,217, and that's 7,092. And then year 4 is 38,950 miles. So times 0.084. And that year's depreciation amount is going to be 3,272. And we subtract that from the 7,092 to get 3,820. And that number's fine. This number cannot be below $3,400, so it can never go below our salvage value. Well, I wish I could get the next method shown to you on this video, but it'll have to be on the next one. So I'm stopping this now, and I'll pick it up on the next method called declining balance.